All right. What's up, traders? What's up, tycoons? Super excited for today's video. Coming in with episode 2 of Trading Prep. I am going to try to be dropping these videos before the market opens on Mondays. So Sundays and Monday morning, I'll be dropping these for you guys so you guys can prepare for the upcoming week in the market. So we're going to break down the heat map, give some summaries of the market and what happened last week and on Friday in the market. Take a look at some really good different aspects of the market. We'll go over treasury yields and what those are looking like. Also take a look at the global bond market treasury yield. Reverse repos, we'll actually break down what reverse repos are and some of the implications for investors and traders. Okay. Then we'll go over the IPOs. So we have officially seen the return of IPOs. We do have some IPOs upcoming, and then we have some recent IPOs here for you guys as well to look at. We'll also take a look at the latest government contracts. Now, Palantir actually recently just got a government contract. We'll go over when it was and why that's pretty interesting here. And then we're going to use all of the data in today's video to basically give us the key levels for the SPY ETF, which is your S&P 500 ETF. So the things we're going to be doing that in basically getting those levels from is going to be the option flow summary. So we're going to take a look at the option flow summary and some of the big flows. We'll break down why you use those flows. Okay, and then we'll also be going over the dark pool levels, the significant dark pool levels, break down what those are, explain to you guys what those are over the past 7, 30, and 100 days in the market. We'll also identify the max pain levels, okay, and explain what max pain is, and then go over the gamma levels here as well too, and explain what gamma levels are for you guys. So that way, y'all have a good idea and can be properly prepared for the upcoming week of trading. Okay, now as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. I do want to mention I started a completely free newsletter called Investment Intelligence, giving out free valuable finance content, as well as try to sprinkle in some free trade ideas in there. This was a trade idea on Tesla, highlighting some of the conditions and chart patterns we were looking at. That trade turned out very nicely. Okay, and this is SWK. This was a bearish chart pattern, so not all trade ideas are long positions. There are some shorts with the rising wedge here, identifying where we thought price was going to go, and that trade also played out very well. And if you're ever interested in a one-on-one personal session, so you want to learn a little bit more of some of the strategies that I use to get really nice, returns on trades like these, well, you can always use the link in the description for my Ko-Fi page. You click on commissions here, and that's where you can directly book your 30-minute and 1-hour sessions. That's the new platform I'm using to book all of those. On there, you can also request a specific YouTube video on the topic of your choice. And you can also click on this little buy a coffee button. It basically has a way to leave a tip or donation for the free valuable content I do put out. Now, let's take a look at the heat map from Friday, and it was brutal, right? I mean, we saw miners going up. Okay, gold has been popping a lot recently, as well as energy. But big tech had a terrible day on Friday, and overall it was a pretty brutal day. You see Amazon down big here as well. UNH had earnings. We had some bank stocks with earnings here as well on Friday. Those all, did relatively decent. When you take a look at the market summary, the SPY closed down 0.5%, the QQQ, the NASDAQ, okay, so tech was down 1.2%, and then you have your IWM small caps down 0.83%. Now, when you look at the percentage of stocks above their 200-day moving average in the S&P, that's right around 30%. So 70% of stocks in the S&P are below their 200-day moving average. This is your 50-day moving average, and we can see that about 80% are trading below there. And then on the advanced decline, you have 37% advancing, 62% declining. Now, again, this is kind of just a breakdown of the overall market and what we saw. The NASDAQ was down 1.2. We saw the S&P was down 0.5. You have the Dow Jones total stock market index that was down 0.56. We talked about the Russell 2000. You have the NYSE composite was basically flat right here, though. Okay, is down 0.04%. You see the VIX, had a significant day. All right. And, the Dow Jones, all right, down 0.03%, S&P 500 futures down 0.13. When we take a look at these sectors, okay, and take a look at basically a daily heat map, Energy was leading the way, followed by utilities. These are very defensive. These are risk-off sectors. This isn't necessarily screaming a bullish market, right? Typically, what you'd be looking for is you'd be looking for tech to be leading the way. And something like consumer discretionary, and you can see both of those are actually at the bottom, right? You want to see tech, consumer discretionary, industrials kind of leading the way. Healthcare is a big weighting in the market, so that did help it out. But, it's not a good look when you have energy, utilities, staples, healthcare all leading the charge on Friday. That basically tells you that the market is very defensive. Those are more defensive sectors and risk-off sectors. Now, the fear and greed index, okay, this is 2023 right here. This was the banking crisis, guys, Silicon Valley Bank. Look at the amount of fear that we're in right now, okay? We're actually dipped down lower than the fear levels during the banking crisis. Now, this was a really good buying opportunity back then. So we'll have to see if this can develop into a good buying opportunity for the future. Typically, you want to use this as a contrarian indicator, right? You want to buy in areas of extreme fear and you want to sell in areas of extreme greed. When you take a look at the put to call volume ratio for equities, you can see it's also at a bearish extreme. Again, just another type of sentiment indicator that maybe you want to start looking at some long positions, rather than some short positions. And then at the bullish extreme is going to be on the bottom. Again, you can see we're over here in that bearish extreme, a level that we really haven't seen since back in 2022. Now, when you look at U.S. Treasuries, all right, the 30-year bond was at 4.77%, yield 4.77%, 10-year note 4.63, right? You can look at the 1 year, 6 month, 3 month, 1 month, global bonds. All right, we have the US 10-year, the German 10-year, UK, Japan, Australia, China. Japan is pretty important right now. All right, Japan is doing a lot of stuff with their bond market and their treasuries that, they haven't done for a very long time, and that's been affecting the US market. Now, this is your yield curve right here. I know it doesn't look like a yield curve, but what you have is you have your, long maturity over here. You have your short maturity over here. And you can see that the 1 month, 3 month, and 6 month T-bills are all still paying more than the 5, 7, 10, and 30-year, right? So, this basically shows that that's how you get an inverted yield curve, right? Is when, the short-term durations are actually paying a higher yield than the longer term duration. So still have that yield curve. Reverse repos. Okay. So we're not seeing much in the reverse repo market right now. And we'll basically explain why that's kind of important. So a reverse repurchase agreement is, commonly referred to as a reverse repo. It's a short-term transaction where one party agrees to purchase securities from another party and then sell them back at a specified higher price on a predetermined future date. Essentially, it's the buyer's version of a repurchase agreement or repo. Now, with the initial transaction, party A is often a financial institution like a bank. So the banks really are the ones who use this. They agree to buy securities from party B, typically a central bank, so like the Fed or another financial institution for a certain price. Then you have the future agreement. So they agree to sell those securities back to party B at a higher price on a specified future date. The difference between the purchase and resale price represents the interest earned by party B. And then you have collateral. So the securities being purchased and later resold act as collateral for the short-term loan. Now, why do reverse repos matter? Central banks like the Fed use reverse repos as a tool to control the amount of liquidity in the banking system. So by engaging in reverse repos, central banks can absorb excess cash from the financial system, which can help in achieving short-term interest rate targets. All right, now it's also a safe short-term investment for financial institutions with excess cash. They offer a way to, earn a return on that cash with minimal risk, as they're essentially lending money with government securities as collateral, and it gives you liquidity management. So financial institutions use these reverse repos to ensure they have enough liquidity to meet short-term obligations without holding on to non-productive cash. Now, the implications for investors and traders. The first one is going to be interest rate indication. So a surge in the demand for reverse repos might indicate that there's an abundance of cash in the financial system. This could suggest that short-term interest rates might go lower, affecting the yields on money market instruments. So that's when you see a surge in reverse repos. short-term interest rates might go lower. Okay. Now, the financial system health, so a high reliance on reverse repos by financial institutions might indicate potential stress in the banking system or a lack of more attractive short-term investment opportunities. And then you have the bond market impact. They can influence the supply and demand dynamics for short-term government securities, potentially affecting their yields. And monetary policy interpretation. The central bank's use of reverse repos can provide insights into its monetary policy stance. For instance, if a central bank is frequently engaging in reverse repos, it might be trying to mop up excess liquidity, signaling a more hawkish stance. So in conclusion, while reverse repos are primarily a tool used by central banks and financial institutions, understanding them can provide traders and investors with insights into the health of the financial system, central bank policy direction, and potential movements in short-term interest rates. So with all of that being said, what do we see? Well, we're not seeing a huge surge up, right? I mean, we're basically seeing the opposite. Okay. We're seeing money coming out, and we're seeing, 3.54 billion in. So nothing crazy there. We talked about IPOs. Birkenstock, I think, is an interesting one that recently IPO'd. Here is a list of all of the other IPOs. And then coming up, we have Pineapple Financial. That's going to be pretty interesting. We have Prospect Energy Holdings, and then we have Globevent Holdings. Okay, so those are all going to be on the 18th. So mark your calendar for those. Research some of those companies if you are interested in participating in the IPOs. Now, this is the latest government contracts that have come out. And I mentioned Palantir. So look at the date on this one, Palantir 10-12. This is right after the whole Israel, Hamas, Gaza situation happened. So, I think that that's really interesting. The government is one of Palantir's biggest customers. And so, oftentimes leaders will reach out to Palantir in times of conflict and also war. We saw the same thing with, in Ukraine, right? They reached out to the CEO of Palantir. And this was a nice contract here, right? It's definitely the largest contract on the list, 5.74 million. And it's very possible that if tensions continue to escalate in the Middle East, okay, it's very possible that Israel may reach out to Palantir for contracts, or that they may get future contracts, from the U.S. government, if things sustain and tensions continue to rise over there in the Middle East. Now, these are all of our key levels for the SPY index for today. Right, we're going to break down what those key levels are and how we got them. But your zero gamma level is going to be at 436. We have a gap fill up above at 438.38. Our call wall is going to be at $440, and the upper range of the weekly expected move is going to be $440.53. Now, your weekly max pain level is going to be $430. Your weekly expected move to the downside is going to be 422.47, and your put wall is going to be at $420.26. So I think that those are all going to be important levels for you guys to monitor over the upcoming week. And we're going to start breaking down what some of those levels are and how you get them. Now, this is our option flow summary for the past week on the SPY. And you can see that the puts in red here, greatly outweighed the calls, right? And we've seen a lot of selling in the market, and we've seen the stock market drop a lot, and so that's being reflected in these option summaries. All right, this is for next Friday. Okay, so at the time of this recording, it's Monday morning, pre-market. This is going to be your Friday expiration day option flow summary, and look at how bearish it is leaning right here currently at the moment. So this is something you're going to want to see develop. Okay, if you start to see a large increase in the call options in the call option flow, that could be a sign that the market's going a little bit more risk on and potentially looking to rally. But for right now, all of the signs are that there is lots of bearishness, right? None of these are even close to $1 billion. All right. And what do we have? 1.43 billion at the ask. We have 1.31 billion at the bid, 1.14 billion at a lean bid, 1.17 billion and in between. So we're just seeing billions and billions on put options right now for the expiration on Friday. Now, these are the big flows, okay? And so this is daily. And so red is going to be put premium, green is going to be call premium. And essentially, this is just another way to visualize, rather than this. And so you can see Friday, we had that really bearish day in the market, and you can see how much the put flows outweighed the call flows here, right? And that's basically been a consistent trend, since late September that we've seen in the market. These are some of the largest prints, all right, for the big flows. A lot with that 10/20 expiration here. We're seeing a $28 million premiums at the 450 strike, $26 million, basically the same strike, just executed with an hour of difference. So this was right before market close, an hour before market close. This was 4 minutes after market closed. And we're seeing some really big prints like that. Okay, here's another one, this time at the 448 strike with $23 million. And we're seeing really, just lots of bearish puts, right? Lots of bearish puts. None of the big flows here are calls, right? So again, this is leaning a little bit more to the bearish side from the option side of things. Now, how do traders use big option flows? Well, it can be used as a sentiment indicator, so they can provide clues about institutional sentiment. For instance, a significant purchase of call options might suggest bullish sentiment for the underlying stock, while a large purchase of put options might indicate bearish sentiment. I can give you momentum clues, so sudden surges in option buying can precede upward or downward momentum in the underlying stock. Traders might look for these surges as potential entry or exit signals. So if we see a sudden surge in call options, okay, that's something you're going to want to monitor. Okay, that could give us a momentum clue. Same thing. We already know that the bears, from a sentiment indicator, right? We're seeing a large amount of puts. So the sentiment seems to be bearish. Okay, but we want to look at those momentum clues to see if we see a rapid increase in the calls or puts, hedging activities. Okay, so not all big option flows are directional bets. Some might be hedges against other positions. For instance, a hedge fund with a large stock holding might buy put options to protect against a potential drop in the stock's price. So think about if you're a hedge fund and you have a billion or multi-billion-dollar position in shares for the S&P 500. Okay, a $20 million put may not necessarily, be such a big impact for you. Okay, and it may seem like a big position to us retail traders. Okay, but you have to remember at the end of the day, a lot of these hedge funds and institutions are managing billions and billions and billions of dollars, and so these really big option flows oftentimes can be a hedge. Now, earnings and events. All right. So when you take a look ahead of earnings reports or significant events, increased option activity can provide insights into market expectations. For example, if there's a surge in the purchase of out of the money call options before an earnings report, it might suggest that some traders expect a positive surprise. Then you've got liquidity and slippage. So monitoring big option flows can help traders gauge liquidity in specific options, which can be useful for entering or exiting positions without causing significant price slippage. This is definitely something that I like to do, is take a look at the options that have really good liquidity. Now, when you're trading the SPY, generally they have some pretty good liquidity across all strikes, and you can get in with a relatively minimal slippage. But it's always nice, in my opinion, to trade some of the options that have the highest open interest or the highest volume for that day or for that expiration strike, expiration date, just as a way of giving yourself some added liquidity and being able to get in and out relatively easy and quickly. And oftentimes, traders can use these big option flows as a contrarian indicator. So some traders do use big option flows as a contrarian indicator. If there's an overwhelming amount of bullish option activity, a contrarian might view it as a potential overbought signal and vice versa. So remember when we talked about the put to call ratio and it's at extreme bearish levels right now, that's one way that someone would look at it as a contrarian indicator, right? When you're seeing this aggressive amount of put options in the market relative to the ratio of calls, oftentimes that can be a bottoming signal and we could end up potentially starting to see a rally, right? So that's basically how you want to use that, right? And that's why we went over these. Okay, and broke these down in today's video. Now, we're also going to talk about the dark pool levels, okay, over the past 7 days, the most important ones over the past 30 days, and also the most important ones over the past 100 days. And so dark pools are basically just private financial exchanges or forums for trading securities, primarily equities. Unlike public exchanges like the New York Stock Exchange or the NASDAQ, where trades are visible to everyone, dark pools offer a more discreet way of trading, which can be beneficial for institutional investors and other large traders who don't want to show their hand before executing large orders. And when people refer to dark pool levels, they're typically talking about price levels where significant dark pool trades have occurred. These levels can be identified by analyzing consolidated tape data, which includes trades from both public exchanges and dark pools. When a large trade occurs in a dark pool, it's reported to the consolidated tape with a delay and without disclosing the specific dark pool where the trade took place. Now, on a cautionary side, there are challenges to the interpretation. It's essential to remember that not our dark pool activity is straightforward to interpret. A large trade might be more part of a more complex strategy or a hedge against another position. There's also a lack of transparency because by their very nature, dark pools are less transparent than public exchanges. While you can see where dark pool trades have occurred, you can't see the intent behind those trades or any accompanying order book data. And then there's also regulatory concerns. There have been concerns and criticisms about dark pools regarding their potential to create an uneven playing field in the markets. Traders should be aware of the ongoing regulatory discussion surrounding dark pools. And some of the ways that traders may use these dark pool levels is going to be as support and resistance. If a significant amount of buying occurred at a specific price level in a dark pool, it might act as a support level in the future as those institutional buyers might defend their positions. It can also, you can use it for volume confirmation. So if a stock breaks out or breaks down on high volume and there's corresponding dark pool activity at that level, it can be seen as a confirmation of the move. Then you've got anticipating future moves. So if there's a surge in dark pool buying at a particular level, it might suggest that institutional investors are bullish on the stock, even if there hasn't been a corresponding move in the stock's price yet. To avoid slippage. So for traders executing large orders, being aware of dark pool levels can help them avoid price slippage. If they know a level where there's been a lot of dark pool activity, they might choose to execute their trade at that level, hoping to benefit from the liquidity provided by institutional traders. And just as with big option flows, some traders might use dark pool levels as contrarian indicators. If there's an overwhelming amount of buying activity in dark pools, a contrarian might view it as a potential overbought signal and vice versa. So here is the dark pool levels over the past 7 days. And remember, we talked about how hedge funds, institutions will have these, huge billion-dollar positions. And so when you have billions of dollars in, let's say, a share price position, and then you're hedging it with 20 something, 20, 40, $50 million worth of puts, that may seem like a lot of money to us, but for them, it's a hedge potentially for some of these billion-dollar positions. Now, again, there's not much transparency here, so we can't always tell if this is one person, if this is one institution, what is always going on behind the scenes. But over the past 7 days, 433.68 is our largest dark pool level. Then we have 432.22 and we have 429.52. Okay, those are going to be the key levels. We've got those charted up on our chart. We have over the past 30 days, we have 430.39 and then 425.79. And over the past 100 days, we have 449.03. Then we've got 430.39. And then we've got 438.49 and 442.52. Those are kind of all of the, top dark pool levels for the SPY ETF, right? Now, this is max pain, okay, for, today's expiration essentially. And then we have Friday's expiration. So we're going to go over, the max pain levels for today and Friday so you can monitor those heading into the week. Max pain in the context of the stock market and option basically refers to the stock price at where the total value of all in the money options, both calls and puts, will be at a minimum at expiration. So in simpler terms, it's the price levels where the maximum number of option contracts will expire worthless, causing the maximum financial loss for option holders and the maximum gain for option writers. Okay. So the whole concept of max pain is based on the idea that market makers who often take the other side of retail option trades will try to hedge or adjust their positions in a way that the stock price gravitates toward the max pain point by expiration. This would allow them to minimize their potential payouts to option holders. It goes over how to calculate max pain here. We're not going to dive too much into that. If you're ever interested in getting access to all of this dark pool data, all of this max pain data, and a lot of basically all of the data sets that I'm showing you guys in today's video is available in my new Discord. I just started it. It hasn't officially launched yet. I'm still getting some of the rooms ready. So if you guys want to join, there will be a link in the description, and I'll announce the official launch, but you guys can get in for free now while I'm setting the rooms up and finishing things out in there. And then, there will be a very small fee, to join once it's officially launched. Now, how traders may use the max pain. Some traders believe that stocks have a tendency to move towards their max pain point as options expiration approaches. They might adjust their trading strategies or positions based on this expectation, especially during the week of monthly options expiration. Now, they can also use it for hedging. So if a trader's portfolio is heavily reliant on options, understanding where the max pain point lies can help them hedge their positions, anticipating potential price movements as expiration nears. Then, of course, you've got the contrarian view, because not everyone believes in the max pain theory. Some traders might use the max pain point as a contrarian indicator, expecting the stock to move away from that price. And then for volatility expectations, if a stock is significantly away from its max pain point close to expiration, it might suggest that traders expect higher volatility or a significant price move in the stock. So our max pain level for today is going to be 434, right? For the S&P 500 ETF, the SPY ETF, 434 is that max pain level. And then you have here 430 is going to be your max pain level for Friday. So pay attention to 430 as the week progresses and we get closer to that Friday expiration. If we start to go below or above that level, just know that it's very possible that the stock might try to gravitate back towards that 430 area by Friday and by the 10/20 expiration. Now, these are the gamma levels here for the SPY. We'll break down, how traders use gamma. Basically, you can use it to anticipate price movements. So high gamma levels can lead to increased stock price volatility. There's also gamma squeezes. So a gamma squeeze can occur when the underlying stock's moving toward a price where there's lots of gamma exposure. As market makers buy or sell the underlying stock to hedge, it can amplify the stock's movement, leading to a rapid price change. Then, of course, for risk management, for options traders, understanding gamma is crucial for risk management. High gamma means that an option's delta can change rapidly, leading to significant profits or losses in a short time. You can also use it for strategic positioning by taking positions in options with high gamma if they anticipate a significant price move in the underlying stock but are unsure of the direction. Since gamma impacts both call and put options, a sharp move in either direction can be profitable. And then you've got expiration dynamics. So gamma typically increases as an option approaches its expiration, especially for at-the-money options. Traders need to be aware of this, especially if they're holding options close to expiration. So we've got our gamma levels here for the SPY. The call wall is going to be here at 440, and then the put wall is going to be at 430, and then your zero gamma is going to be right there at 436. Now, this is the smile. This is the option smile chart right here. It gets that name because it looks like a smile, kind of. All right. If you're not familiar with that, basically, what you're looking at is a U-shaped curve when plotted against different strikes. All right. This is the implied volatility of options forming a U-shaped curve when plotted against different strike prices. This pattern is called a smile because it's resemblance to a smiling face on a graph. All right. Now, the way that traders will use this is by identifying mispriced options for hedging, anticipating volatility changes, strategies exploiting skew. So advanced traders might employ strategies like volatility arbitrage to exploit differences in implied volatilities across strike prices, and then also for event prediction. So while the volatility smile provides valuable insights into market perceptions of risk and potential price movements, understanding its nuances allow traders to make more informed decisions, whether they're buying or selling options, hedging a position, or trying to capitalize on perceived anomalies in the options market. So we can see this Monday expiration. The implied volatility for puts is much more elevated. Okay. And then you have, your calls right here. The implied volatility is a little bit less, right? Remember, we're basically right around here for the price of the SPY ETF right now. So what we're seeing is that, as the strike prices go up higher, implied volatility for those put options is increasing here. And, it's much more elevated than the call options there. And then we have, Friday's expiration here. We're seeing something very similar. Okay. Basically, with implied volatility being higher, okay, that's going to affect the price of your options. So put options are going to be more expensive right now, if you're going out of the money, right? Or I'm sorry, if you're going in the money. Okay. So, these would all be in the money on the right side right here. And then out of the money is going to be over here, over towards the left. And you can see the big price difference here, in the calls and in the puts for the SPY ETF. Now, that's basically it for today's video. So don't forget to sign up for the completely free newsletter. Okay, it's called Investment Intelligence. There's a link in the description for you to sign up in that and get access to that free valuable finance content sent straight to your inbox. If you want to join the Investment Intelligence community, I did just start a Discord for it. I'm still getting it set up right now, so it's not officially launched. So you can join for free now, but that's where I'm going to be posting all of the trade ideas and trade setups from now on. So the newsletter will have a couple sprinkled in, but in the Investment Intelligence Discord, you'll be able to find a large amount of different charts and setups that I'm looking at in the market. And don't forget, if you ever want to reach out for one of those one-on-one personal sessions that I do every week, and figure out how we trade options and how we do things like this, and choosing some of our strike prices and what are some of the strategies behind those, then go ahead and use the link in the description to sign up for the Ko-Fi page. On there, you can click the commissions tab and you can book directly a 30-minute or 1-hour session with me, as well as request a specific YouTube video for you on the topic of your choice.